and letting everyone in. All right, everyone, it is top of the hour, so we'll go ahead and get started. We have a shorter session today, so let's get as much information as we can. Just a reminder for you guys, all of the phone lines have been muted, so if you do have any questions, please feel free to use the Q&A box located on the menu bar, or you can use the chat feature. And just as a reminder that this webinar is not for CPE credit today. So we will go ahead now and turn this over to Tanya and Sean and get started. Tanya, if you click on the screen, you should have control.
Perfect. Thank you, Amy. And thank you everyone for joining us for our second roundtable today. Oh, sorry, I'm going a little fast here. So here is our roundtable session. So first I'm going to introduce myself, then I'll introduce Sean. So like I said, my name is Tanya Rule. I lead the Affordable Care Act services for Eide Bailey, and I've been with Eide Bailey for 20 years, and I have been working with the ACA since it came out in 2010. So with that, Sean, will you please introduce yourself?
Yeah, hi everybody. My name's Sean Delury. I've been with the firm for 9 years, and like Tanya said, I've been working with the ACA as well since it was passed in 2010. Hard to believe it's been 10 years, but also it's been a long 10 years on the another side. So ever since it was done, I also bring 15 years of consulting experience as well. So with that, I'll give it back over to you, Tanya.
Perfect. Well, as you can see, here is our roundtable session schedule. So if you weren't able to be on the August 7th roundtable, there is a link to the video you can upload and watch because we're not going to go through those questions again. So obviously everyone knows when you signed up, you were able to submit 3 questions. We kind of pulled those questions together and put them in these few categories. If at the end of October 23rd you haven't heard your question asked, it's either because we didn't understand what you meant or maybe we thought it meant something different. So if it doesn't get answered, please reiterate the question in a different way and send it to us via email. Now, we did get some questions on like the PPP loan forgiveness. We are not covering any of that, so we're only covering ACA topics here. So with that, here's what we covered in session 1. And now obviously, I'm sure most of you know the Supreme Court case is a huge topic right now. Unfortunately, there's no new news on that. You know, they're not hearing the ACA case until November 10th. So really nothing more to go through that right now. Sean, do you have anything to add?
No, I agree with you, Tanya. We've talked a bit about it as it was passed, obviously, or as it was brought up in the news with Ruth Bader Ginsburg's passing. But, you know, it's just we don't know what the implications of that is for the case. I mean, it's going to be heard, or we think it's going to be heard in November as was planned, but we don't know if there's going to be someone seated or if it's going to be who the Republicans are nominating, or if it's someone different, or the election. So coming up, we just really don't know what's to come of it. So the best thing to say kind of right now is what's going on in the news, and then kind of at the end of the day, we don't know what the implications of that are. So I guess the ACA reporting is currently here, and that's the important thing to know until it changes. And if it does, we will send out a communication on that.
Perfect. Thank you, Sean. So before we get into the affordable offer of coverage, let's back up and talk about our deadlines. We'll talk about that a little bit more in our final one too, but remember, like Sean said, the ACA reporting is still on, and as of now, we don't have an extension on those due dates like we've had in the prior years. Typically, that extension comes out via an IRS notice somewhere between Thanksgiving and Christmas. So it's really too late to wait for that extension to see if we get it. So you really need to start getting your form information together now and start getting those preparation of those forms underway. In case it doesn't get extended, you'd have to give those forms to your employees by January 31st. Now remember, in that notice that we typically get every year, we get that good faith effort reporting. So again, we don't know if we're going to get that, and we won't know until that notice comes out. Now, I'm on the edge whether I think, we'll get that good faith effort reporting this year or not. In June, we had a report come out from the Treasury Inspector General of the Tax Administration, and basically they gave the IRS kind of a slap on their hands, if you will, and said, they think that the IRS should be penalizing more when employers are doing these forms incorrectly. So they've got employers that are doing the same errors in multiple years, and the IRS is letting them get away with it if they made a good faith effort. And basically they're saying, really, is that a good faith effort if they already made this error before? So my suggestion is make sure you understand how these forms are to be done. If you do these forms and there are errors in them, and there's not that good faith effort, or if you didn't even make a good faith effort, you can receive a penalty on those forms. So find someone to review the forms. I know we review the forms here. Otherwise, maybe someone else in your office. Have a second eye look at those forms just in case. Catch those errors before they're submitted to the IRS. So with that, let's go ahead and get started talking about the affordable offer of coverage. So remember, if you're a large employer, if you have 50 or more full-time equivalent employees, if you want to avoid the ACA pay or play penalties, you have to offer affordable and adequate coverage to substantially all of your full-time employees. Now, Sean will talk about that substantially all standard in our next slide, but let's go back and see what is affordable coverage. That was really the question that was asked. Well, if a large employer is offering coverage and wants to avoid the penalty, they need to offer affordable coverage to the employee that's full-time. And affordable means it has to be affordable according to the self-only premium to the household income of that employee. Well, how does an employer know what the household income is? They don't know what that household income is, so the IRS gives us 3 safe harbors, and the safe harbors are listed there. They're the same as they have been over the prior years. However, the amount changes because the percentage changes. So you can see right now it's at 9.78%. I believe last year was at 9.86%. So the 3 safe harbors that employers can use is the box 1 of the W-2, the rate of pay, or the federal poverty line. Let's talk a little bit about each one of those. So the wages in your box 1, to me, that's the kind of the easiest one to use because you know what the wages were last year. So you can pretty much guess what the wages are going to be this year. The problem is we don't know those wages until the end of the year. Another problem, remember, box 1 takes into effect all of your pre-tax items. So if someone's maxing out their 401k, for example, it's going to lower that amount. As long as people are working more than 30 hours a week, the box 1 of the W-2 wages probably gives you a better result than the rate of pay. Because if I'm working 40 hours a week, or if I get a bonus, all of those dollars are put into box 1 wages. And so it would make it so my plan is technically probably more affordable when I take the box 1 wages times the 9.78% divided by 12. That's what I would have to, I can't pay more than that amount. Whereas the rate of pay, that is set at 130 hours a month. So if I'm working 40 hours a week, It doesn't matter. I take 130 hours a month times 9.78%. Times my rate of pay, excuse me, and that is what my threshold is. So if I receive an increase or I receive a raise throughout the year, I don't get to take that into consideration. There's several places in the ACA where I always say the employee always wins. This would be one. So we had a client one time that noticed that their rate of pay calculation was off, so they were going to give some people raises. You can't take into consideration a raise. You can take into consideration, or you have to take into consideration, a decrease in your pay though. So it's your rate of pay. So again, it's 130 hours times the rate of pay times 9.78%. The federal poverty line, that's the nicest one to use, a little bit more spendy for the employers. So we always use the 2019, so the prior year federal poverty line, and the 2020 or the current year threshold. So we take that 12,490, which is the 2019 federal poverty line. We take that times the 9.78% and divide that by 12 months. And then we would get 101.79. So as long as the employee is not paying more than that for self-only coverage, that plan would be deemed affordable. Now, why I say that federal poverty line is the nicer one to use, it's because when you fill out the forms, you don't need to put in a safe harbor on line 16 of the forms. It's just automatically deemed affordable if you offer that type of coverage. Now, remember, it doesn't have to be affordable for the spouse or the dependents, but you do have to offer it to your dependents. So with that, Sean, I'm going to pass it over to you to talk about the next bullet point.
All right, thanks, Tanya. So the next one asks how to prove the offer is affordable and available to all. And then there's some sub bullet points under that. And as I look at that question, that really gets to crux of the 1095C, because when you're offering coverage and you're filling out the 1095C, you want to make sure that you are offering coverage to all, or as Tanya said earlier, substantially all of your full-time employees. And that gets to that 95% rule, which is that sub bullet point 3. So when the ACA came out, they said that employers have to offer coverage to all full-time employees. And then as they were codifying it and putting rules to it, they decided to put a 95% rule in there instead of 100%. So it gives you a little bit of leeway on offering coverage to your full-time employees, gives you a 5% kind of cushion, if you will. But you do need to offer to 95% of your full-time employees. Otherwise, on the 1094 that accompanies the 1095s to the IRS, there's on the back you would indicate where you indicate all 12 months that you offered. If you didn't offer to 95 on some of those months, then you have to check box no. If you check yes, then the IRS can audit all these statements, the 1094 and 1095. They can look and say, get some backup for your claim, and then they can see, did you really offer to 95% or not? So the need to track hours is still there because we have this requirement to offer to all of our full-time employees. So we do need to track those hours. And then another important consideration is when are employees hired? So that next sub-bullet point under it, the first one. Because as you've probably heard or have done in prior years, there is a difference between hiring someone as full-time and hiring someone as what the ACA calls variable employee, which is a part-time or otherwise not a full-time employee. And that depends on a couple of factors. When you're hiring an employee, you're looking at the job that employee replaced. Was it a full-time employee that position was before? Was the job advertised to potential candidates as a full-time job? Has it been a full-time job in the recent past, and those types of considerations? So I want to look at that when you're looking to define that employee as full-time or variable. So if they're hired as full-time, then they will be put into what's called a waiting period and what the forms call a limited non-assessment period, where they're not offered right away when hired. It's shortly after they're hired. So typically it's 60 days, which is in the first of the month after 60 days. And then if full-time, so you're offered on that day. If you're variable then or part-time, then you may not qualify to receive an offer. So there's that. We'll get into the implication of that on another slide when we start talking about the measurement period, because there's implications on when they're hired, if you call them variable, there's a different measurement period rule for variable hired than full-time employees. So yeah, the available to all is an important piece of the 1094 and the 1095s, because if they're full-time, they should receive a 1095C. And even if you didn't offer coverage to them, they still should get a 1095C. And if you didn't offer to 95% of those full-time employees, then we need to check these boxes no in the months that we didn't. And that would expose us to that pay penalty, which is the 4988J penalty we talked about on our prior webinar, which is $2,570 times all the full-time employees. So if you have 100 full-time employees, the first 30 are free, you would have that roughly $2,600 penalty times 70 employees. If that happened for the entire year, in other words, we were under 95% for the entire calendar year. So 95%, like we talked about on the other webinar, is an important thing to keep in mind. And the affordable piece, Tanya, did a great job going over the affordable definitions and calculations on the prior slide. We just want to make sure that we're choosing the right method. You can do the calculation yourself, or you probably have payroll software that does that calculation. We have a software we use for the reporting and measurement period that can help calculate the affordability, because sometimes you're surprised, there's differences between the rate of pay and the W-2 method. You may feel that the W-2 method may be the best, and then as you're looking at the information, the rate of pay might be better. So you can use that rate of pay method instead. You just want to make sure that we're consistent with applying that method for the same class of employees, and not, let's say we have a school, we have bus drivers. We don't want to apply like W-2 to 2 bus drivers and the rate of pay to the other 27 bus drivers. That wouldn't be consistent, as an example. They just say you want to be consistent. So I think that covers everything there on the affordable piece and why it's important to make coverage available. So with that, I'll pass it back over to you, Tanya.
Perfect. Thank you, Sean. So affordability of a family plan, we touched on that a little bit later, or earlier, I'm sorry. Hang on one second here. I'm going a little fast. Affordability of a family plan. The family plan does not have to be affordable, only has to be affordable for the employee. Next question we had, do grandmothered plans need to comply with the affordability provisions in the ACA? So I'm assuming you did mean grandmothered versus grandfathered, but let's take a step back and talk about how the plans work. So states get to decide first off if they're going to allow the grandmothered plans in their state. The state also gets to decide who's in what plans are in the small group market. So by default, it's 1 to 50 are in your small group market. Anything 50 or over, I should say, are in your larger group market. And states can decide if they want to bring that small group market up to the 100 threshold, 100 employee threshold. So with that, grandmothered plans are really your individual and your small group market plans. If you are a large employer, that's when you need to worry about the affordability, and your plans do need to meet that affordability threshold, or you would be subject to the 4980HB penalty for that employee, assuming that employee goes to the exchange and receives a premium tax credit. So with that, Sean, I'm going to turn it back over to you to talk about the 2 measurement periods.
Okay, thanks, Tanya. We did receive a kind of leaping off question on the methods, and it's regarded to measurement periods, but I think it can apply to both. Really, do we still need to track hours? We're in the 5th or 6th year of the reporting. We've done 5. Do we still need to track hours? And kind of how I said earlier, we do want to track hours and continue to, because it's really important to determine who's full-time and who's part-time, because if you're full-time, you should get a 1095, and if you're full-time, you should also receive an offer if we're trying to offer to substantially all, or in other words, all full-time employees. So we do still need to track. There's good news that we do have some flexibility on how to track those hours. We have 2 methods we can use. There's the default method, or the monthly measurement method, and then there's the kind of safe harbor method, or the look back measurement period method. So the monthly method, just in summary, is in some ways it's an easier method because there's less rules around it. In other ways, you could run into some situations which I'll describe when I unpack this definition more. So the definition is you're doing just that. You're looking at hours for every month of the calendar year. Now it kind of gets back to which payroll method you use. If you use a semi-monthly method, then you can just use the two payroll methods in a month and go, are we over the what's defined as full-time, which is 130 hours in a month. So if I have employees above 130 hours in a month, then they're full-time. If you look at the biweekly rules, it gets a little different because you need to use what's called the weekly rule or the weekly convention. And the reason is because if you look at a biweekly rule, you have 26 payroll periods in a year. And if you try to put that into the 12 months, you'll have some months that have 6 months and some that have 3, and that just doesn't really make IRS didn't think that made sense. So they decided you need to cut those biweekly payroll periods into weekly payroll periods. And so you do that, and even when you do that, you're going to run into 5 months a year that have 5 weeks, and the other 7 months of the year will have 4 weeks. So we're going to run into some that have more weeks than others. So what they said was, okay, take the number of weeks in a month and multiply it times 30. So the 4 weeks are times 30 to get to 120. The months with 5 weeks are times 30 to get to 150. And the only reason I bring it up is a lot of clients and a lot of companies have biweekly payroll periods. They're using monthly. They want to make sure they're cutting those biweeklies into weekly pieces. And the other thing is, if you're doing that, keep in mind that the bar to determine a full-time employee will change in those months. Again, 4 weeks is 120, 5 weeks is 150. So that's the monthly rule. The trip with that is you may have, depending on your industry or workforce, you may have a staff or a workforce that has a lot of employees that are variable. They work under 130 in 5 months, and they work over 130 or 150 in those other cases for some other months. And the monthly method goes, okay, well, did you offer coverage to them after they became full-time? And you can say no at the beginning, right? But then if you have a month after where they worked full-time, say they were full-time in February, part-time the other month, and became full-time in September, that September month will be a no offer month. So, and again, that gets to that 95% rule that we really don't want to trip if we can help it. So the monthly method seems easy to do. You do hours every month, but you really got to watch hours because an employee could move between full-time and part-time in those months. So the other token is the measurement method, which tries to solve that issue by saying you can look at hours over a defined period of time, usually up to 12 months. And 95% of our clients, I'd say, and what we do is probably a 12-month look back. So you can measure hours over 12 months. You can have what's called an administrative period to look at those hours and make offers to employees. Then after that, you have what's called a stability period where they are locked in as full or part-time based on the results of that measurement. And we'll go through this example here to kind of illustrate how that works. So we have, in this case, we have a variable hour employee hired by the company on 8/1 of 18. The company uses a 12-month look back from 6/1 to 5/31. They also have an initial measurement period for variable employees. And both measurements, the standard and the initial, have a 1-month administrative period with it. Don't have to have it all the time. This example happens to have it. Oh, I can't click, Tanya. Sorry. Oh, I can, never mind. Spoke too soon. So here's the illustrative example laid out. You have an IMP starting when I was hired on 8/1 of 18 to 7/31/19. So that's the 12-month there. You have a green admin period for a month following that to look at the hours of the initial measurement and decide is that employee full-time or not. You have an initial stability period or a stability period just following that admin period for another 12 months from 9/1 to 8/31/2020. We also have our standard measurement period, which goes every year we do this, same period of time every year from 6/1/19 to 5/31/20. So 12-month SMP standard measurement period. We have an admin period following that for a month to look at all the hours for all the employees in that standard measurement period, determine who's full-time, determine who's part-time, and make offers when we need to full-time employees. Then we have a stability period following that from 7/1 to 6/31/2021. which is that locked in period where that employee will be full-time if we measured them as full-time, part-time if they measured less than 30 hours a week on average over that standard measurement period, part-time employee locked in as part-time. You'll notice that there is an overlap in the stability periods that will often probably always happen when you have an initial stability period and a stability period. So we have a 2-month lock there. And what happens there is that, since it always happens, there is some specific rules for things that happen with the measurement. And in this case, if you're full-time in the stability period, you will continue to be full-time. So if I'm part-time in this initial stability period, but I measure full-time in this standard measurement period, that will change me to a full-time employee during the stability period. If the shoe's on the other foot and I'm locked in as part-time here in the stability period and I'm full-time in the initial stability period, I will be defined as full-time in that last 2 months in the stability period. It's that employee always wins criteria, and that's the case there. So we do have locking up there, and that's the result of it. So that's the example. With that, I'm going to turn it back over to Tanya to talk about some of those more some other specific rules that come up with the measurement period.
Perfect. Okay, so another question we were asked is how to measure employees with fluctuating hours. Well, Sean just kind of went through that. Really, again, the monthly measurement period is really meant for those employees who are part-time or who are full-time. It's not meant for those people that have fluctuating hours, meaning those variable hour employees. If you do that for those type of employees, you're likely going to get caught in a trap. And they're going to hit 130 and you're not going to know it until the month end. So if you do have fluctuating hours, like Sean was explaining, better to use the look back. One question that came up, what do we do if we used inaccurate measurement period resulting in inaccurate filings? Well, assuming that so here's what we've seen before, that the files get filed via the payroll software, and the payroll software, the output's only as good as the input, and someone didn't know that they had to input the measurement period. So the payroll software defaulted to monthly or defaulted to the look back that they thought it was to default to. So if the forms were filed that way, you should go ahead and correct those forms. Part of that good faith effort standard is if you see that there was an error made, you're to correct that error. Now, let's say you don't notice that that error was made until you get either a 5307A from the IRS or a letter 226J from the IRS saying, hey, you owe $2.5 million in a pay or play penalty. If at that time you look, there's always a table that has all of the employees listed on there that you're receiving the penalty for. And once you see that table, it's actually a 14765 table. If you're looking at that table and you say, hey, Jane Doe really wasn't full-time, I don't know why she's on this table. It could be that your software just generated a form for a part-time employee or didn't have the measurement periods correct. You can respond to the IRS at that time. Again, it's always easier to amend those forms than to wait till that notice comes in and deal with that notice. So if you notice that you're doing it wrong, switch it now before you get a notice. Once you get a notice, you cannot file a corrected form. So another couple questions we had were reinstatement offers. I think what you meant on that question, that was all that was listed, was rehires. So remember, our rehire rule is 13 weeks in general. If you're an educational institution, it goes to 26 weeks. So if you rehire someone and you're going to reinstate that offer, if they're hired after 13 weeks, they come on as a new employee and they can have a new waiting period. If they come on before 13 weeks, regardless if you're using that monthly or the look back measurement period, you have to offer them insurance, and it says as soon as administratively possible. And then it goes on to say that the first of the following month is deemed as soon as administratively possible. So where I see this getting, where I see most employers getting caught up with this is our school districts. We have teachers that retire in May and they come back as a football coach, let's say in August. They actually do need that offer right away in September then, the first of the following month, because they came back within that 26-week period. So make sure that you have those, get that signed waiver. It's easier to answer an IRS notice if you've got those signed waivers and you can prove, yes, I did have the offer on the table, they declined that offer. And I should note here that when you get those waivers, keep them indefinitely. February of 2020, there was a chief counsel memorandum that came out that said there's no statute of limitations on these forms. Obviously, there's no statute of limitations on the forms because the penalty is not, when you file the forms, you don't know what the penalty is going to be because you have to wait and see if someone goes to the exchange and receives a premium tax credit. That's how the IRS is going to know if they're going to penalize you. So because that penalty isn't readily able to be calculated, there's no statute. So they can go back all the way to 2015 if they want to and ask you for those forms and your backup documentation. So the next question, how to comply when seasonal employees meet the ACA requirements but not the health insurance plan requirement. We see that a lot as well. Your plan document is wrong. Your plan document really should mirror what the law is, not the other way around. So just because your plan document doesn't state that you have to make an offer once someone hits 1560 if you're using the look back, it doesn't mean you're going to get out of that pay or play penalty because your plan document was outdated. So you really need to go back and make sure that that plan document is updated to what it should be to match what is law. So with that, I think there's a couple questions if I can weed through here. So there's one question, if you have a full-time employee that doesn't happen to work the 130 hours 1 month, do they become part-time for that month or do they stay full-time in your FTE calculation? Well, that depends on what method you're using. So if you're using the monthly and you hit 130, you're full-time. If you hit 120, you're technically part-time that month. The next month you hit 130, so that's where that fluctuation is really better to use in the look back. So to answer your question, if you're using that monthly, you hit 130, yes, you're full-time, but if you drop down the next month, then that particular month, you're part-time. Now you don't get to use that whole new waiting period all over again, you get one waiting period. So make sure that, because otherwise you could really play a game, right? You could have a 60-day waiting period, someone could hit 130, you give them 60 days, but then they hit 120, then you give a new waiting period. You cannot do that.
Yeah, I think it's one waiting period per employment period. So if you're there like 9 years, I believe you get one waiting period. So it's kind of an interesting piece of the monthly.
Right. Another question comes in, if an employee goes from full-time to part-time, how long after they're part-time do we have to offer an insurance? That's a good question. We weren't asked that question anywhere in our roundtables. So basically, I think what you're asking here is if you're using the look back, because it wouldn't really be applicable to the monthly because you're measuring them monthly if you're using the monthly. So if you're using the look back and someone's in their stability period as a full-time employee, the rule says if someone changes status and takes a part-time position and they work 3 full consecutive months and average under 30 hours a week during those 3 full consecutive months, on the first day of the 4th month, you can drop their offer of coverage and call them part-time as long as they were offered insurance that met minimum value standards after their waiting period when they were first hired. Mouthful. So let's go back and give an example. Let's say on April 15th, I go to Eide Bailey and I say, hey, I see you posted a part-time position. I'd like to drop down to part-time hours. So then May, June, July would be 3 full consecutive months. I can't use April because I just dropped down to part-time status April 15th in this example. May, June, July, 3 full consecutive months as long as I average under 30 hours a week. May, June, July, August 1st, they could drop my offer of coverage and obviously I'd probably be offered COBRA, but they could drop my offer of affordable coverage and classify me as part-time. As long as 20 years ago when I was first hired, I was offered a plan that met minimum value after my waiting period. That's how that works. What is the difference between grandfathered and grandmothered plans? Good question. We don't have a lot of them. I have a lot of people think they have grandfathered plans and they really don't. So I've only seen a couple of them. So grandfathered plan was a plan that you had in place before President Obama signed into act the Affordable Care Act. Actually, it's the Patient Protection and Affordable Care Act, and that was on March 23rd, 2010. So if you have a plan that was in place before then, there's small parameters that that plan can move, not a lot. Now, a grandmothered plan would have been in place prior to 1/1/14. President Obama had kept extending those grandmothered statuses. Basically, if you have one of these plans, you don't have to abide by all of the market reforms that were put in place. You still have to abide by, no annual dollar limit, no lifetime benefits, max on your benefits. So there are still some of the provisions of the ACA that you have to abide by. Typically on those grandmothered plans, if you have a younger work staff, they're probably affordable. But if you have an older work staff, I'm assuming you don't have a grandmothered plan anymore. It would be too expensive. Another question, we file our forms. I'm sorry we're going over. If you guys have to jump off, I totally understand. It will be recorded. But to answer the last question, we file our forms through a payroll service vendor. When the IRS tells us that there's an error, after 4/1, are we required to fix the Social Security number? You should fix the Social Security number if you can. You're supposed to ask 3 times. So the first time was when you gave them insurance, and the second time is when you find this error, and then if they're not answering you, ask a third time, document that you asked. If it's a dependent and the Social Security number is wrong, you could flip it over to the birth date. I would still suggest fixing it, flipping it over, and getting it corrected. Any other questions? I don't see any come through. Oh, I do have one more. Hang on one second so I can read it. If you have less than 50 employees for a nonprofit, do you have to worry about these forms? Not unless you're self-funded. So if you're self-funded and you offer insurance, anybody who takes that insurance does need a 1095B form. And we should note that even if the IRS extends the deadline, the states, if you're in a state that requires filing, that state may not extend their deadline. So be cognizant of that when you're watching for any extensions of the ACA deadline. So with that is all our questions. We'll log off. We really appreciate you joining us. Please join us for the roundtable number 3, which is in October. It was on that earlier slide. If you have any questions, you have Sean and my contact information. Thank you and stay safe, everyone.
Awesome. Thank you all so much for attending, and we hope you guys have a great day.